Good evening, everyone. It's David Linker from Davlin Wealth Management. Welcome to the webinar this evening. Now, before we begin, I'll just like to make sure you can hear me. So could you raise your hands? Just click the icon and that way I know that, that you're hearing me. Fantastic. Okay, so you can hear me. That's great. Got the technology sorted out. Limited support is available this evening from a technology perspective because everyone's busy. But I think the busyness starts after 8 o'clock with the state of origin. So plenty of time to get to that. Well, welcome, as I said. My name's David Link. I'll be your presenter this evening. And tonight we'll be talking about property and superannuation. They're the two key assets we have for retirement. And we'll be examining the different characteristics both of these asset types have and to see if they can actually work together and be best friends in retirement. The webinar will go for about 45 minutes with 5 to 10 minutes for question and answer, and I'll be aiming to finish well before 8 o'clock. Along the way, feel free to ask me any questions and I'll get to those during the slides. And if I'm not able to get to them, I'll see if I can answer them at the end, but ask them as you go. And that way, if it's pertinent, I'll address them along the way. Okay, a little bit of information about me. So as I said, I'm the principal of Davlin. My background is as an accountant, mortgage broker and financial planner. I've worked with the Property Club for many years. I also hold 5 investment properties, very familiar with this strategy. And I've been doing financial planning and retirement planning since about 2007. Okay, so what I'll be talking today is about retirement planning. And it's very important to understand that it is general advice only, and I don't know your circumstances. So before you take any actions based on the information this evening, it's important to get your advice either from a planner, a tax agent, or a mortgage broker. Now, for more information, you can email me at fp@davlin.biz, or the website is there. And a bit of information people don't know about because information about financial planners is not well known in property circles. You can go to the website advisorratings.com.au and there you can actually pop my name in there or the name of your financial planner, or if you're looking for a planner in your local area, just put your postcode and all the ratings will come up of the various financial planners. You're most likely very conversed with how to find a good mortgage broker. Certainly you ask your property mentor or branch manager. For a financial planner or retirement planner, you could ask your property mentor or branch manager, but additionally, it's important to find out how that financial planner rates nationally. And that's why I've given you that website, because most people don't know. And I'll give you this information at the end as well in case you missed it. Now, I asked you some questions when you registered, and that'll give you some information about the people here this evening. We had 140 registered, so quite a large registration. And in terms of the retirement time frame for the people online this evening, 25% said they've got 6+ years to retirement. So that's fantastic. 40%, or a large portion, said they're looking to retire in the next 1 to 5 years. And 35% said ASAP. They're looking to retire straight away. Now, in terms of the key asset in retirement, 34% said others. I'm not sure whether that refers to a business asset, but 16% said super. So a small percentage, and the overwhelming majority said property is your key asset. So we're in a climate where interest rates are increasing, and for the bulk of you, 75% of you are looking to retire. So let me start off with a poll. Let me go to that and I'll launch that. And let's start off by getting a little bit interactive and ask you, with interest rates on the rise, what's your retirement strategy? Now, this is a multiple choice question. You can put as many as you wish. So it won't take much time. Let's just see what you're looking at. So this is not David Linker telling you what to do. It's what are your thoughts? So it won't take too much time. There's no right or wrong answer. Okay, so 5, 4, 3, 2, 1. Thank you very much. And let me share that poll with you. This tells you what people are thinking. So 44% are looking to sell down the portfolio. 33 and 33 either refinance a portfolio if possible, cash in the super as well to fund it. 26% said they're not sure. Well, you will be sure at the end of the webinar. And 15% said to delay retirement. The key thing with retirement is you've only got a limited time to enjoy your retirement. I call that the active period of retirement. So if there was one that I would have a really good, robust discussion about is delaying retirement, because effectively you're limiting the number of years available to enjoy your wealth. So that's often one that I would look to avoid if possible. So sell down the portfolio. No, absolutely, it's not right or wrong. Refinance if you can. The key reasons are for interest only. Cash in the super, yes, but after the webinar this evening, you'll see whether that's suitable for you. And unsure, well, tonight's webinar will help you, give you some information. So let's hide that. And I can see a number of familiar faces. Hi there, Fred in Queensland. I won't say your wife's name because everyone will know who you are. And over in Loxton, nice to have you at our lunch the other day. So yeah, nice to see some familiar faces. Should have had you guys as speakers as well on this webinar. So anyway, yeah, but nice to see you. Nice to see you online, and thank you for your support. Okay, so now that you have an idea of the people online in terms of the time frame, the key assets, what people are thinking with higher interest rates, let's go to the next slide and look at what retirement looks like. So in order to answer the question, is property and super compatible? How can they be best friends? Well, it comes down to what does your retirement look like? What does your retirement transition from work look like? Often it's not a case of ceasing work altogether. Often there's a phasing period, whether that's contract work, a part-time work in an unrelated field, or using up long service leave. We need to understand what that actually means. Hi there, Kim. Hi there, Lisa from Sydney. Nice to see you online. So that's really important, and it all has a big bearing in super and property being best friends. Okay, so you need to, as a retirement planner, when I meet with people, I hear a lot of statements and I need to convert them to numbers. What does it mean from a financial perspective? So you might say, David, I'm earning 100,000 a year. My transition of work will be down to 40,000 for 3 years and then zero. So we need to express it in financial terms. Living expenses in retirement. What are they currently? Often people say, well, David, what do most people spend? And I'll say, well, you're not most people, because if you're, for example, in Darwin versus Wagga Wagga versus Manly in Sydney versus lovely Loxton in South Australia, you'll all be very different. And the best way to find out your living expenses in retirement is to find out what are they currently. Okay, so I don't like using the averages because you're not an average person, you're special, you're unique. What are your living expenses? So I always say to people, have a look at your last 6 months expenditure, doesn't matter what it is. Look at your last 6 months credit card statements, maybe saving statements, and double it. And if it looks too high, dig a bit deeper. Are there any capital expenses in there? Capital being one-off items, like maybe replacing a motor, or you did that renovation for the bathroom, or you put that air conditioning system in. Take those out because they're one-offs to come up with the annual living costs. And sometimes that can be a pleasant figure or it can be a little bit surprising, but it reflects your living expenses in retirement, so that's very important. The other one is one-off costs. When we're looking at retirement and making super and property best friends, if at all possible, what are the one-off costs? So if you've listened to any of my other webinars, you would notice that in starting off retirement, often there's costs, for example, to replace a vehicle. Maybe you're looking to buy a caravan and do the grey nomad thing, or maybe you're looking to buy a jet boat or a jet ski or a kayak, who knows. But if you're going from working to having a lot more time, you need to be able to do something with a set of golf clubs even. So what are the one-off costs? I had a client the other day that said, yes, we're looking to retire, but I've got 2 sons and I need to plan for their wedding. So we said, well, let's allow X amount of dollars, a couple of years apart. And we don't know when they'll get married, but we need to allow for that one-off cost. And the last question in terms of the retirement goals and objectives is, where will I live in retirement? Often people talk about downsizing. My question in relation to understanding that is, well, okay, that's releasing money out of your home. And what would be the result of the surplus? Where do we invest that? The other thing with downsizing is often people have a holiday home. How does that factor into it as well? So that's very important to understand. But when your primary place of residence isn't included in the retirement plan, the retirement funding plan, so we need to make sure that's sufficient for the frail stage, which is your aged care bond. But that's a good question. So in preparing for retirement, just getting away from super versus property, these 4 considerations are very, very important before I can actually help you, or for that matter, any retirement planner can assist. So have a look at those. Okay, let's have a look at the next slide. Now, questions to consider when you're looking to commence retirement is, can I even afford to retire based on these? And that's a question for the retirement planner to assist you with. The other one is, when can I start? So once you've got these 4 key areas sorted out, when can I start retirement? Will I run out of money? That's very similar to, can I afford to retire? Because you're not going to if you're going to run out of money. And the last one is the many range of what if scenarios. So it's important when you complete a retirement plan to run those what if scenarios to make sure you're totally comfortable. Because the biggest fear that people have out of these 4 is the third one: will I run out of money? And it's because of that that people don't retire. And it's because of that that people don't consume any capital. They'll just live off the earnings. The federal government did a report called the Retirement Income Review 3 years ago. And they said the quality of living for retirees has actually fallen because people are not comfortable with consuming any capital. They're just living off the earnings. So as a result, they leave too much money for their estate upon death, and they don't live a comfortable lifestyle. So these questions need to be addressed without a shadow of a doubt. So they're the other questions to keep in mind. Now let's look at the retirement life stages. So we do retirement planning a little bit differently at Devlin. So most retirement planning is based on taking a linear approach for the next 30 or 40 years. But I think that's a bit too simple. So we have 3 life stages when we talk about retirement planning. One is active, and that could be for 10 or 15 years, who knows? One of the questions I ask people to answer is to get yourself a health check done, a full medical, to make sure as you start retirement, everything is sorted out. Get a bit of a tune-up, an overhaul, get the heart checked, skin cancers, all the various bowel cancers, all of those, to make sure you're good and ready to go. If you're starting retirement healthy, let's budget for 10 to 15 years of what we call active living. What does that mean? Well, it means you spend more because you've got the health, so you can do a lot of the active pursuits. How long does that last for? Who knows? But let's budget for 10 or 15 years at a higher spend level. After that first period of active, then comes passive. Now, what's passive? Passive is when health problems start to occur and you're forced to live a more sedentary lifestyle. So it's very different from active in that you can't be active because you've got some aches and pains. Hopefully that's the most of it. But in other cases, it becomes a bit more serious. So you cannot live an active lifestyle, so it's more of a passive or sedentary lifestyle. And I can see a couple of people putting up their hands. I hope that's not assuming you're already in passive. I hope no one misses active and goes straight through to passive. Yeah, it's important to start off and spend the money whilst you have your health, because when health starts to fail, you have no option but to go to passive. And the last stage is called frail. And that's when you can't spend. That's when you need care. And who knows, but I've said 5 to 10 years. Does anyone know the average time spent in a nursing home once you enter it? Pop your answers in the question and let me know what you think that is. Okay, I've got some answers coming through. So we've got 3 to 5 years, 3 years. We've got 7 years from Darren. 2 years. It's actually 5 years. It's not very long at all. And hi there, Peter. So yeah, it's not actually long at all. And the 10 or 15 years, what's the science for that? Well, there's actually no science. I'm just trying to make sure you don't run out of money. So active and passive is 30 years. So if you imagine you retire at 60, I've budgeted for 30 years, taking you to 90, and then I've said another 10 years, so that's 100. Okay, so in terms of longevity, the longevity tables would suggest you'll pass away a lot sooner. So what I do is budget for you to live more. Okay, so that's the basis for the 10 to 15, 10 to 15 for passive and 5 to 10. Okay, so thanks for your interaction there. Now, put up your hands if this is the first time you've heard of this type of retirement planning with a health-based approach, and I'll just bear that in mind and unpack that a bit more. Anyone new to this, where it's a bit new, where you're spending more upfront and less as you go? So it's a health-based approach. Okay, so a number of you have raised your hand. So this is the model that I developed after the GFC when I started doing retirement planning, because when I was an accountant, moved to become a mortgage broker in about 03, and then in 07 became a financial planner. And when I did all the financial planning, it was just a linear approach, which is X amount of dollars based on the figures from APRA over the next 30 years. Often it's about 50 to 60,000 for the next 30 years, but it was too simplistic. And so I developed the Devlin retirement plan. But you can see how it makes sense to spend more when you're healthy, and you've got no choice because you can't spend towards the end. Okay, fantastic. How are we going for time? Not too bad. Okay, and so active is what I call your best retirement. That is your best years in retirement. So it's important to make sure you've got enough funds available to spend. And then we move into passive. And passive is where we target Centrelink eligibility. Okay, it's really very important to do that. And look, if we can't optimize it for you and you're not eligible, good for you, because it means you've provided for yourself many times over. But it's a bonus. And when we do the retirement modeling, I always twist and turn and reshape it and make sure I've done everything I can to optimize the Centrelink eligibility during passive. Why? That's when health problems start to occur. Okay, so that's what I do during passive, and passive is that second stage of retirement. And the third one is frail. And this is a serious issue because people worry about running out of money inactive, and so they don't spend their money inactive. So emotions are a big part of my retirement planning, because not only am I presenting numbers, I'm dealing with mindsets, from you being a property investor and a wealth accumulator to shifting your focus on preservation of your capital rather than accumulation. 99% of people, when they retire, are still focused on the accumulation of wealth as a mindset. But when you're no longer working, the focus has to shift to preserving the capital. So it's really very important to understand why you think what you think, to make sure that you don't take unnecessary risks. So I'll leave the various life stages there, active, passive, and frail. And it's something for you to have a think about when you're doing your retirement planning. What am I allowing for an active? How does it compare to my current living expenses? Well, hang on. If I'm spending 70,000 currently and I've got all the time in the world, surely I must need more than 70, because what am I going to do? I don't have the money, so we need to increase it. And then passive is similar to your current, but less so because it's more sedentary. And then frail, well, got a budget for those colouring in books and the Play-Doh and playing with doing some painting and bits and pieces like that. Okay, so let's talk a bit about property now. As we're going, just pop in the questions. I've got a number of them coming, and I'll answer them as we go. Richard actually asked a question. He said, should I pay down the mortgage debt in retirement? Well, not necessarily, Richard. Comes down to looking at the property portfolio, looking at the overall cash flow associated with it. And extending that question further, should I pay down the mortgage? That infers you're selling as well. It comes down to whether the portfolio can support you in retirement. And the answer to that is based on what's your living expenses? What's your active allocation? What's your passive and frail allocation? And the answer to that is the first question. What does your retirement look like? What are your goals and objectives? What sort of one-off costs are you going to have? What's your transition plan? So you can see how it all has to come together. But let's put property under the spotlight and have a look at that. And let me highlight the 3 bullet points down below. Now, when you're in retirement, the mindset change. Wealth preservation is the mindset change in retirement versus wealth accumulation. Okay, have a think about that. That's the first time you've thought about it. Think about retirement. You're no longer working. You're entirely reliant on your capital base. So it shifts to preserving the capital rather than accumulating it, which is your default position. The second bullet point is maximizing income versus capital growth. Income is what determines the living how much you can comfortably live on an active, passive, and frail. If you've got enough in your asset base, why would you be going for more capital growth? Well, let's say you've got over and above, in which case I agree. But for many people, they've got sufficient, and it's a case of making sure there's enough income being generated. And the third bullet point for you to have a think about is liquid versus illiquid assets. So tonight's key, really, the answer to can property and super be best friends, it's answered by that third bullet point. Liquid versus illiquid assets. Question was raised by Arun. Doesn't wealth preservation depend on your risk profile? Well, wealth preservation focuses on not losing capital. And a consequence of that is adjusting the risk to suit accordingly. Okay, so if you're focusing on managing the risk, one of the consequences of that is lower growth, of course, because the focus shifts on maximizing income. And the only reason we'll do that shift is if there's enough in there and the retirement plan suggests you can live comfortably in active, passive, and frail. So some of the comments that I make you may not agree with, fine, that's good. My role is to introduce different concepts. And it's particularly to shift your mind to think retirement rather than accumulation. And some of those concepts can be a little bit challenging. A number of you made some comments about missing out on growth and not agreeing with that. That's fine. It's good to have a bit of debate, good to get some lively discussion. Okay, but when I act as a retirement planner for you, my focus is on seeing if the current portfolio works with very minimal capital growth, and how to maximize the income so you can live your best retirement in that active part. But just keep those 3 bullet points in mind. So let's look at property. So when we look at property, the first thing I do is look at the portfolio cash flow. So if you've got 100% assets being your investment property, the key is to make sure the cash flow is neutral, if not positive. Now, if it's neutral, you don't need to be an accountant or a financial planner to know you need to sell to generate some liquidity. And even if you had other assets apart from property, if it's negative, what you're doing is taking money out of super, not only to fund your living expenses, but also to fund the portfolio. So you will drain your liquid accounts very quickly. So in retirement, it's important for each asset type to stand on its own. So in retirement, the portfolio cash flow needs to be neutral or marginally negative, or a plan to return it to neutral. Otherwise, you'll have liquidity problems before you know it. Tighter credit guidelines, and that was evidence yesterday with the rate rise. Now that stunned the market altogether, and it will flow through to already tight credit guidelines. And this will certainly be challenging for those looking to refinance. Let me clarify one key area in terms of refinance in retirement. It's not possible. Okay, so when you finish working, it's highly unlikely you can refinance. Okay, there's no low doc or no doc loans anymore, and unless you have income. So once those interest-only loans revert to principal and interest, not only will the loan repayments go up significantly, because the P&I repayments, the principal interest repayments, are based on the remaining term. So if you've had 2 lots or 3 lots of interest-only extensions of 5 years, the P&I repayments are based on the remaining term of that loan. So if you've got a 25-year term and you've had, say, 3 lots of interest only, 15 years, the P&I repayments are based on paying off the loan in 10 years. So when I do retirement planning for people, I'm very mindful of that. And if you can't refinance, what'll happen to the portfolio cash flow? Yes, it'll go negative. So that's interest only reverting to P&I. We've talked about that. It's helpful to do that pre-retirement if you can, but inevitably all of the loans will revert to P&I. The other challenge is in an increasing rate environment, I'm thinking with inflation going up, rents will increase as well. So if your portfolio is already neutral, if interest rates go up, you can almost be assured that rents will follow shortly afterwards. So from a cash flow perspective, it's not that bad, but from a rate environment and a credit perspective, it's actually very difficult. The next one is ongoing maintenance costs when you're holding property. So when you're holding property, that can certainly be a challenge. And as the properties get older, those maintenance costs increase. So that is a challenge with property in retirement, those ongoing maintenance costs, because they need to be funded, and that can eat into your cash flow, your retirement cash flow. So that can be challenging as well. Let's go to the next one. The other thing is with any income generated from the portfolio, it is taxable income as well. Okay, so it's not as tax effective as versus super, that last bit, because the income generated from super in pension phase is tax-free. Okay, so property in retirement is great, but there are some problems we need to be aware of that need to be addressed. And some of these, in the current lending environment, we don't have solutions for. It's just what happens as things change. After the GFC, away went the lines of credit and low doc and no doc loans. We used to talk about harvesting the equity, and I know there was someone who put a question about that. Tony said using equity in the investment properties to live off, not possible anymore in the current guidelines, haven't been since the GFC. So with property in retirement, I hope that gives you an idea of the characteristics that we need to address. But unfortunately, the big ticket item being the interest only reverting to P&I and tighter credit guidelines, and to some extent ongoing maintenance costs, and to some extent taxable income means it's not optimal anyway. It comes down to looking at these as a package to decide what you can and can't do. Okay. Now, some people are asking some tax questions, but that's not the scope of our discussion today. I'm an accountant, but it's important to check that with your tax agent. So let's now have a look at superannuation in retirement. And once again, bear in mind, I've got the 3 bullet points. In retirement, change your thinking. Now, if you're a person who hasn't thought about retirement and you're in that 75% who are 1 to 5 years or ASAP, write these down. So when you make your decisions, ask yourself, am I in a wealth preservation mode or wealth accumulation? How does this decision affect preserving what I have versus getting more? How does it affect me maximizing my income versus capital growth? Generally, they're inversely related. And the third one is liquidity. What's it? Is it liquid? What level of liquidity is this decision? Well, the first thing about superannuation is it's very flexible cash flow. You can draw out, you are required to draw out a minimum amount once you retire, but you can draw it as much as you wish. Obviously, it affects the amount in your super account. But the great thing about superannuation and retirement, not to say there's no great things in property, please don't misunderstand me, but in superannuation, there's flexible cash flow. And one of the retirement focus points was maximising income. So superannuation can do that because you can draw out as much as you wish. The other one is Centrelink assessment. Now, I don't have time to go into Centrelink assessment, but it's one of the criteria we factor in when we do retirement planning. But essentially, it's very favourable. It's much more favourable than, say, if you had an asset worth 400K as an investment property versus 400K in super, the superannuation is assessed more favourably. And you've got to understand the Centrelink assessment guidelines in order to know that. But I certainly come across it when I do the retirement modelling for people. The superannuation or financial assets, whether it's a term deposit, a share portfolio, is assessed more favourably based on the asset and income assessment test that Centrelink has. The other one is it's tax-free income. So you'll know that the income that you draw down once you're in pension mode is tax-free. So whether it's $60,000 a year or 200, it doesn't matter. It's all tax-free. And there is a problem though, contribution limits. It might be a good idea if you're listening to the webinar. You might be thinking, what if I sell my properties and pop it into super? Well, you can't. You just can't. There are contribution limits. And look, I'm not in favor of you selling the property and putting it into super, because if you're comfortable with property, that's your asset type. So look, I can't tell you what is the best asset type. What I can tell you is what is more favorable for retirement. But if property has made you wealthy, I wouldn't look to change that because that's an asset you're comfortable with. And just be careful about planners. If they say to do one thing and do another and you're comfortable, there's many ways to skin a cat to do a retirement plan, but the numbers are the numbers. So it's a case of how can you get to that retirement plan by keeping your asset of choice. So often when people come to me and say, David, I was told to sell all my properties and put it into super, I'll say, well, hang on right there. Is it necessary? Maybe you need to sell one or two to boost your liquidity, but it doesn't make sense to change your asset type if you're not comfortable with it. And the last one is multiple one more to go. Multiple investment options within super. And someone talked about a question relating to asset allocation. Otherwise, it's a fancy word for risk. So within super, you can change the risk of where the money is invested. Okay, it's known as asset allocation. So if you're new to retirement planning, write that down. My goal in this webinar and all the webinars I've done is to increase your financial literacy. So asset allocation is a term you need to understand. So most of my clients, well, nearly all of them, are property investors. I never have people coming to me wanting retirement planning and they just got super. And for all of them, they're not comfortable, they're not familiar with super. So I've done a lot of webinars on superannuation, but a term that you'll need to understand is called asset allocation or risk profile. So write that one down to understand. But the point here is there's significant options available to invest the money. And the last point when it comes to superannuation in retirement is it's a flexible tax planning tool. Very important. Why? Because when you sell property and let's say you've got a capital gain, superannuation, particularly the deductions, can be brought forward under something called the catch-up provisions. So it's very important to be aware of the tools. And if you sell a property and your accountant hasn't talked to you about that, you need to, well, if your accountant hasn't talked to you about it, it's a bit of a worry, but how can super be used as a tax planning tool? It's through the catch-up provisions, okay? So that's very important. Okay, how are we tracking here for time? Running very well. I'll just pause to ask a couple of questions, answer a couple of questions so I can catch up. How do you beat the banks? This is Ray. How do you beat the bank's requirements to service a loan due to APRA? Well, it's a case of have a chat to your mortgage broker, Ray. They are getting tighter, but it's a case of yeah, the banks have very firm guidelines. So if you meet the requirements, that's good. Otherwise, you need to go to Plan B. And the other one from Aideen, should you own all your property before retiring, or sell a few to pay down debt, or just go interest only for cash flow? Everyone's different, Aideen. So once again, it comes down to the goals and objectives, what retirement looks like, active, passive, and frail, your level of properties, your level of super, and putting it all together. Only when I have that can I answer that question. Own all your property, sell a few down to pay off some debt, or go interest only. That's a very specific questions. Should we sell property to fund retirement, says Richard. Well, if you don't have enough liquidity, yes, you should. One more before I push on. Does a loan drawdown, this is from Doug, does a loan drawdown work if you're subject to amortization, redraw or offset? Can I get a line of credit? Generally, these features are available on all loans, offsets less so if you're a second tier, with a second tier funder. But it's loan drawdowns is limited in terms of a long-term funding strategy, okay, in the current credit climate. Okay, and then the last one, Lindy said, what qualifies a property owner to access Centrelink? Well, it's the income and assets test, Lindy. Property is treated a little bit differently to non-property assets, but you need to have a look at the income and assets test. Okay, let's keep going. Okay, so the key in retirement for today, I want you to go away with is liquidity. Okay, and liquidity is key for retirement. Okay, so next time you meet with your property people and you're all in that retirement age, 75% I think it was of people who registered said they want to retire in ASAP, or 1 to 5 years, so in the short term. Question is, talk about liquidity. Okay, it's a really good concept. So this is key to tonight's webinar. So liquidity, let's now look at liquidity and look at the breakup of your retirement nest egg. I've got a couple of questions coming in regarding mortgage broking. If I get to them, I'll answer those. But once again, those are key to having a chat with your mortgage broker. And in order for me to look at that, I certainly need to understand what your current position is, looking at your fact find, so to speak. Okay, so remember I said the liquidity. So we need to identify what's a liquid asset, what's an illiquid asset, and what is not included in R&E, which is the retirement nest egg. So let me start off with firstly asking you, what is your retirement nest egg? Any thoughts? Type in what you think should make up your retirement nest egg. Okay, I've got some answers coming through. It's the combination of all of your assets excluding your home. Okay, so when I mean all, thanks Pete, all savings, cash and super and property, less all of your debt. Fred said cash, share, super, property, investments. Ruth said super and home. Arun said super and property. No one said anything about liabilities. Maybe I should be assuming you mean net, but thank you for your interaction there. So retirement nest egg, that's another important concept, to write it down. So your retirement nest egg is what you start off in retirement. So imagine you're starting off retirement tomorrow. We exclude your home, so put that in your back pocket. It's everything else. Okay, so it's all of your property, all of your super, all of your other investments, that's all of your debt. Doesn't matter whether the debt is deductible or not. So it's everything else except your home. So it includes all other assets minus all debt. So that's your retirement nest egg. That's what RNE stands for. And if you're lucky enough to have a pot of gold, well, good for you, Pete, good for you. Okay, let me ask you a question. So with shares, let's say he's got a parcel of shares. Would that be considered in the liquid or illiquid, or not included? Okay, I'm just warming you up now at the moment. I'm going to ask you some more difficult questions. Yeah, that's right. That's an easy one, guys. So thank you for that. So it goes in the liquid ones. What about a painting? Okay, I'm not talking about your finger painting you did in primary school or the grandkids. Let's say you've got a collectible. Yeah, I would agree. It's illiquid. Anything that takes a while or is a unique or an immaterial, I would say, is illiquid. Okay, so sometimes we can have parcels of investments. Sorry, let me take that back. When we have an immaterial asset, I will call that illiquid as well, because it's not going to make a material benefit. Okay, the next one is superannuation. Is superannuation liquid or illiquid? What are you thinking? Yeah, that's right. It's liquid. Why? You can access it pretty well straight away. Next one is, what about a collectible motor vehicle? Is that liquid or illiquid? Or shouldn't it be included in the RNE? Yeah, it's illiquid. Okay, despite you loving that vehicle. Centrelink classed furniture. I'm not really sure what that means. But furniture or home and contents is not an asset, so I wouldn't even be including it in here. When I look at retirement nest egg assets, these are the assets that I look at to help you with your retirement planning. And if you said, David, I've got some furniture, I'll say, well, I don't want to know about it. So it's not included. What about silver bullion or coins? Yeah, it could go as liquid or liquid, but if it's not material, like if it's not more than 40 to 50,000, I'm not that concerned about it. Okay, and yes, all of these assets are included in the Centrelink assessments test, including your home contents, which includes things like paintings, furniture, and bits and pieces. Okay, now property portfolio, where does that go? Liquid or illiquid assets, or not included in the RNE? Yeah, of course, yeah, that's right. It goes in property portfolio, it's illiquid. That's great. The family home is not included in the retirement nest egg. Now for bonus points, so family home is not included. What about the holiday home? Is that included in liquid, illiquid, or not included in the retirement nest egg? Any thoughts? And we need to go through this because this determines the funding for your retirement plan. So with the holiday home, it depends. So that was a bit of a trick question. It's certainly illiquid because it's a property asset, but it depends if you're using it. I had a client that wanted to keep the holiday home in the family, so we didn't include it in the retirement nest egg. But in order to be able to do that, we need to make sure the other components that there's enough sufficient assets to fund their retirement plan. Okay, so it's very important to make sure if you're going to take a property and gift it essentially, or keep it in the family, it'll be included in the red bucket, not included in the RNE, but we need to make sure the remaining liquid and illiquid assets are sufficient to keep everything ticking over. Okay, so that's the holiday home there. Okay, so let's now try to put it all together and answer the question of superannuation preference. It comes back to what we initially started off with, retirement goals and objectives. So you work for 45 years, let's say you start 20, and then after 45 years, you've built up this retirement nest egg. And at 65, if you're even, your lifespan is in the early 80s, so 65, we're talking less than 20 years, you work for 45, you spend it in 20, and that doesn't look like a great deal to me. So I would say we bring that 45 back. And that's why I'm so focused on living your best retirement, to make sure that first phase of active, you really go hard on that, because otherwise it's not really a good deal. the number of people who come to see me who are already in retirement and have utilized a number of years of their active and then found they're not able to continue living in active because passive has come too early. Is no good, because then in those active years you've got a limited time. So make sure you number one, get that health check, and number two, do your retirement plan so you can spend and live your best retirement in active. Then comes passive, and then the last one is frail. So coming back to the liquid, illiquid assets and what's not included in the retirement asset, the combination of the liquid and the illiquid has to fund active, passive, and frail. Now frail, there's not much funding requirement there. The biggest one is the aged care bond. And remember I said that we don't include the home. We kept that in your back pocket. The reason for that is that pays for the aged care bond. And so as far as super and property, they have to really work together hand in hand. It's not a simple case of saying, look, I'm going to use my super first and then sell the properties. It's a case of using them both together hand in hand, because one, they've got very different characteristics. It's not as simple. Based on the slides earlier, I talked about property as a retirement asset and super as a retirement asset. A depth of knowledge is required of both of those areas to come up with something that works for you in active, passive, and frail. Okay, let's look at your retirement, and I'm coming to the end of the webinar, and there's a number of questions that have come in, and I'll look to answer them before we go out of time. So firstly, that's the information about Dublin. You can either email FP or look at the website, or if you've already got a financial planner, that's fine, but find out how they rate on advisorratings.com.au. We do have a number of retirement webinars. This is must be my fifth one I've done. I did 3 that through a run by Dublin. I did another one through the Property Club a good 6 or 8 weeks ago. So there's a total of 4.5 hours of fantastic fun entertainment. Have a webinar party. And then we've got 2 services when it comes to retirement planning. One is preliminary retirement advice, and that's for people under 55 years of age. If you're over 55, we offer something called the retirement modeling advice, which is very specific. So service number 1 is, I won't say it's basic, but it tells you pretty well if you're on track or not, and what you need to be looking at. Service number 2 answers that question: when can I start retirement? How much can you live on for active, passive, and frail? And the third question, will I have enough money at the end? So that's very detailed, the service number 2. Okay, so let me go through some of the questions now. So I'm scrolling through, and some of the ones are registration. So I've got one on superannuation. Angel says, should super be used or should I focus on selling down the property? Well, I think I've addressed that. It's not as simple as looking at each asset individually. We need to look at it together, and the goal needs to shift to your active, passive, and frail. Don't look at it at property versus super. It's a case of, well, what's your retirement goal and how do those assets fit in? Ed says, can you deposit the proceeds of a property sale into your super if the sale occurs years after commencing retirement? Subject to the contribution limits, Ed, and they're getting more and more complex all the time. So before you consider that, certainly get advice from your financial planner. Robin says, with rates increasing, how can you continue to build a property portfolio? Well, my question in relation to that, Robin, and understanding it is, in retirement, why are you looking to build? You're in automatically wealth accumulation mode if you're building. So you need to ask yourself why you would, with interest rates increasing and in retirement, looking to build. So let's say you're in wealth accumulation mode with increasing interest rates. How can you? Well, the first thing is to get a mortgage assessment done from your mortgage broker and then check the cash flow. Tim says, can you buy your own premises in an SMSF? Well, once again, the liquidity question. So firstly, the answer is yes, I'm accredited to SMSF as a mortgage broker and financial planner. We do a lot of SMSF work. A lot of the SMSF work I do is to purchase your business premises in your SMSF. Some people say to me, David, should I buy a residential property in my self-managed super fund? And firstly, before you set up an SMSF, you need to make sure you've got about 250 to 300K, because the costs of setting it up are not cheap. The other question I would say is, before you set up an SMSF, you need to look at the tax benefits, because the tax benefits in the SMSF are 15%. And are the tax benefits outside of super higher? And if you're working, I can almost always say your marginal tax rate is going to be higher than 15%, which brings the question, well, why are you buying a residential property in your SMSF? And the third question is in your area of liquidity. You're buying another property type, which is illiquid, in your SMSF as well. So it's a really good discussion to have. Paul says, how can you continue to service loans when interest-only periods expire? Well, unless you can refinance, you can't. It's a very simple question now on that one there, Paul. Lucy asks a good question. How do you afford to retire if you don't fully own the property portfolio, but not yet eligible for the age pension? Well, it's the full gamut of the retirement planning, Lucy. I'd look at your property portfolio, look at your retirement nest egg, look at your portfolio cash flow, and bearing in mind property as an asset, it's a bit harder to get access to Centrelink. Not to say your goal should be Centrelink. So why is the goal Centrelink? What about if you looked at the properties? Is there enough equity to live comfortably? Maybe you have more than enough assets in retirement already based on your equity, and you don't need Centrelink. So it's just a way of looking at it differently. A couple more questions, and some people have just sent them in via the question and answer. So Tony says, using equity in my IPs for income versus paying loans off and living on my super as a self-funder. That's a nice statement, but I'm actually not sure what you're saying, so I'll move on to the next one. What do you have to do at retirement to qualify for part pension? We seem to not qualify for any government assistance. Well, it's a case of getting advice. For us, when we do the retirement planning, I can tell you exactly which financial year you'll be eligible for the age pension, and exactly how much. And often, a lot of our clients, not a lot, some of them come to me and say, David, you told me I'd be eligible for Centrelink in this financial year. We've gone and they've said no, and I'll say, well, let me help you fill in the assets and the income information. I'll give them a printer generation, and they'll take that to Centrelink, and then they'll find that they are eligible. Okay, so that's it there. Wendy wants to buy one more investment property before retirement. That's a question for your mortgage broker. And I think the other questions I've pretty well addressed. So if there's no other questions, I don't think there is. I'd like to thank you for your attendance this evening. It's always a pleasure talking about retirement planning. It's really, I don't have any more of a thrill when I can actually help someone do a retirement plan and see the look on their faces when they can see that actually it works for them. So it's been a pleasure talking with you this evening. Enjoy the State of Origin if that's what you're looking to do. If it is recorded, it'll be shared via the Property Club. And the information is there if you'd like to make contact with us still. But thank you very much, and I look forward to talking with you at one of the seminars. Bye for now.